Well, Mark, let's talk a little bit more about the streaming business in particular. Of course, there's a lot of focus on the content slate and maybe subscriber growth actually returning to growth. Is that your expectation as well?
I think it's a possibility, but I definitely don't think it's assured. The thing with Disney is I think the expectation is that they would have this really broad library of content and like new content regularly, which is essentially Netflix's formula, and they just don't. And so they're relying more on that families have to have Disney in the home and things like that, and that doesn't seem to be holding up in terms of not only attracting subscribers, but also kind of retaining them and keeping them. And so there's just a fundamental formula in terms of how they execute the business that I think is making it fairly unpredictable right now. And you know, it's kind of hard to forecast the future, certainly for investors and probably for them themselves.
So Mark, there's sort of two components to that. Obviously the subscriber growth and what investors want to see with regards to it returning to growth, but also ad sales as well. And I am curious as to what Disney has done to make progress on, I guess, bolstering ad sales, specifically on the streaming side.
Yeah, so the real issue there is the advertising business for what you think of big brand advertisers. There's essentially a market share war. You had all of these networks. There's 199 sources of like network quality content in the U.S. And then you have Netflix coming in. You have Disney Plus coming in. And so even if you get more business, you're probably getting it at a lower price. So you might be growing the amount of like kind of advertisers you have, but they're not necessarily growing the price they pay. And so until there's an industry shakeout, this is a relatively low growth market for like kind of large scale brand advertising with like major players now battling it for market share. It doesn't bode well for growth like right now.
Well, then, Michael, I'll pose that question to you as well, because as we speak here, I think Warner Brothers Discovery came out with their earnings. They had something like a 12% drop in TV ad revenue, or total ad revenue, I should say, in the most recent quarter here. And I'm wondering how much of this becomes a concern for Disney investors, not just for ads on the streaming side, but also for their network operations as well.
We know that the cable networks are really on a continued decline. As a firm, we're forecasting we're about 66 million homes today with cable, and we're forecasting within 3 years that's going to be down to 55 million, and that's driving a lot of the declines in advertising. Everyone's down.
Well, I'm glad you bring that up, because people are still watching this stuff, or at least they're trying to watch this stuff. But some of these companies, like Disney, are locked into a lot of these contracts with the cable providers that limits what they can put out online or into streaming services, right?
It does, and yet those distributors are paying more money. I mean, so the advertising may be down, but the affiliate fees that are being paid are increasing. I don't think it's been holding Disney back. A lot of the Disney programming on their streaming service, they keep creating more programming. And what people keep forgetting is the programming is an investment. It's an asset. It's not necessarily a direct expense.
Yeah.
And as much as all of the streaming services say they're going to decline their investment in programming, they're not going to have a choice but to continue to spend on programming.